Welcome back to the show, and I have a special repeat guest with us today. Most of you know him, you know his name. His name is Aaron Chapman, and he is one of the best investor-friendly lenders out there. So welcome to the show, Aaron.
Thank you. I appreciate a repeat back on here. I don't know how many times this is, but I'll take it and I'll keep coming back.
Wonderful. Well, okay. So, Aaron, because you are the go-to investor-friendly lender, I came up with a idea and I wanted to grab you and throw you on the show really quick. A lot of our listeners are new, some are experienced, some have done some things, some have done a lot of loans, and I would say the bulk of our listeners are new. So under 5 doors they've purchased. And there are so many questions that people have to do with lending. And I think people hesitate to call up a lender and actually ask them. I think people think that either their questions are dumb or they're going to sound silly or the lender's just going to kind of talk over their head and throw out numbers or make them commit and run their credit that day. So I kind of thought that I would ask you this question, Aaron. Now, I don't know. I'm going to throw this out there. I don't know. Are you ready? You ready for this?
Fire it off.
Okay. So, what is the number one question that somebody asks you or your team when they first jump on a phone call with you guys? What is your most asked question?
Well, I'm not going to go with the one that's the obvious one. The obvious one is what's your rate, right? Well, interest rates are published, guys. They're pretty close. You're going to see from lender to lender such a small margin that my opinion always going to be you shouldn't be judging where you go based upon interest rates. You're basing it upon who can help you become successful as a real estate investor, because having a good team is going to matter everything. If you just only jump around to people who's the cheapest out there, you'd have one of the shittiest organizations there is, because there is no CEO that hires other members of the C-suite, if you will, because they'll take minimum wage. Right. So let's take that one off the table. I think the most common question that comes up throughout the entire process, from the very beginning till the very end, would be, why do you need that? Everybody asks that question.
Okay, so expand on that. Are you saying people are saying every single time there's a line item on an application or on the closing statement, somebody says, why do I need that?
Well, let's go into really the first time they ask it in a process is when we're going through our pre-qual process, and it's a lot deeper dive. For when a person is buying a home, we as the lender fall into the trap of, I just want to be as simple as possible with the least amount of problems. I want to make them happy to go with me. So I'll pull their credit, get a pay stub, and I'll say, you're qualified. Well, when they contact us and we'll say, hey, here's the items we need to get your pre-qual done, they're like, why do you need all that? Like, well, have you ever been through the process of a loan and you're the week of closing? You have literally spent, you got your pre-qual, you went hunting for a house for about 3 to 4 weeks. You finally got into contract on a home. You're gathering all the stuff you need. You're getting your insurance. You're making sure you're getting your inspections. You're making sure you're happy with this home. And then the week you're supposed to close, you're literally at that point. You spent money on inspections. You spent money on appraisal. You spent money on new furniture. Everybody's really ready to go with this property. And then the lender wants all these documents. Like, why the hell didn't you ask that a long time ago? Well, because I'm trying to be the guy who's the least intrusive at the beginning. I want you to feel really good about the deal. I didn't want to bother you a lot up front. I'm of the mindset, bother the hell out of you when the stakes are small. Because when the time clock is ticking, the last thing you want to be is thinking everything's done. I'm at the last week of my deal. I can coast into closing, and now I have to scramble. I have to find time in my calendar that I was not ready for to start hunting for all these things to get that off to you so we can close on the day that we're required. Because sometimes there might be penalties if I don't make it happen on time. I'm more of, hey, you haven't even found a house yet. You haven't even gone out there looking yet. You're just trying to find out what's possible. Let's gather everything we can now. One thing I have noticed, that when we fail to get something, that's the one thing that bites us in the ass the last week of the deal. So let's just get it all. So I spent my career since 1997 focused on what little things happen in every deal and analyzing, where's the problem here? Where's the problem here? Where's the problem there? And I'll either find a document or a process or an individual to put into that process to try and limit those. Now, are people coming up with new problems? Sure, they come up with new problems all the time. Other things that we run into, let's just say we deal with a lot of real estate investors who are self-employed, and they'll give us a copy of their personal tax return. Well, we look at the tax return and it shows that parts of your income are derived from other items, not just your W-2. You have that there's a reference of a 1099 in there. There's a reference of a K-1 in there. So we'll ask, hey, can you get us a copy of that? Then they send us a copy. And it's like, why do you need the 1099? Why do you need the K-1? Well, we need to see where that money came from. It just says right there, a reference of a K-1. I need to see the K-1. Well, then you get the K-1 in there. It's like, guess what? You own 27% of this business. I need the business tax returns. Well, why do you need that? Because when you own more than 25% of a business, we now have to look at the business itself and cash flow the business. Now, believe me, when I ask for something like this, or remember my team asked for this, and you hate to go get it, we hate 1,000 times more to read it because it's miserable to cash flow a business. We don't ask it because we enjoy it. We ask because there's no way we're going to get the deal done otherwise. So that's one of the big things is, why do you need that? Well, I already gave you what you asked for. Why are you asking for more? Because what you gave me created a new question. Now we have to get the answers to that question. Now, it doesn't mean when I get the tax returns, we're done answering questions, because it can rabbit hole like crazy when it comes to that. As complicated as you make your life is as complicated as we have to make the loan. That would be one of the biggest issues with why do you need that? Another why do you need that would be stuff like, why do we need a full appraisal, right? Why do we need to get an appraiser out there to go through the property when Zillow says it's worth X and I'm buying it for even less than what Zillow says? Because we need to have some sort of understanding of the sales in the area within the last 90 to 120 days that shows us what's really happening in that market. When you have certain things missing in the appraisal, we're going to have to send the appraiser back out, because he's going to say something like, it's a subject to appraisal. So, well, we got to send the appraiser back out there when they get some of these things done. Well, why do we need to send the appraiser back out? That's another $150. Well, because we need to verify that work was done. When you have a contract built and you have information within that contract that states certain people agreed to certain things, we too are required to verify that those things have been accomplished before we close. Otherwise, we could be held liable for closing a transaction for you where all the agreement was not met. So all parties kind of have to have a little bit of oversight that the agreement has been held up throughout the entire process.
Yeah. And, one of the things that I tell people all the time is quit looking at your lender as the bad guy, because I get it. It can be stressful, especially if you're not organized and you don't have all of your information in a file. In fact, everybody should have a Google Drive or a Dropbox folder, and, try to be as organized as possible with your tax returns and any rental properties that you already own. The lenders are going to ask you for the leases. They're going to ask you for the property management agreements. If you have loans under your name and you're doing a loan under your name, DSCR loans are a little bit different if you've got that. Sometimes we're not going to get into that today, but regardless, we want to stay organized. But the lender, the way that I explain it to people is, let's say you're putting 20% down on a property. The lender is funding you 80% of the deal. They're at a higher risk than you are. They're putting more money out. So they want to make sure that the house, it's not falling apart. And so when you guys send the appraisal out there, appraiser, so walk us through that. Like, what is the appraiser looking for in order to protect not only the bank who's lending the money, but also the investor? What are they looking at?
Well, first and foremost, they're going to give an opinion of the value and verify that the property that is being sold to you is reasonably worth what they're selling it to you for. Now, there's going to be some variance from appraiser to appraiser. They're also going to look at the quality of the construction. Is this something that is going to be standing for a while, at least the term of the loan? They're going to look for hazard in the property. Is there certain things associated with that property that's going to be hazardous to people occupying it? That you want to know that as a person buying it. It's amazing how people get really, really caught up in what's my value. What's he say is it worth? But you really want to understand this is an underwriting process for you as well to know whether or not you're buying a property that's safe for the tenant, because you don't want that coming back on you. Other thing you're going to look at is the neighborhood and what's happening within the neighborhood, especially as investment property. They want to see what's going on with the rentals in the area. Is it renting for enough to make the payment, right? When we get into DSCR, we want to know that. You want to know that. It's another level of underwriting. They're also going to give you a little bit more idea of other things that are happening within the market as to valuation per square foot. I mean, there's a lot of data within there that you're probably not going to look at in entirety, but we are as a lender going to look at and understand that everything is functional, that there's no obsolescence in this property. There is no problems that are going to come back and bite you in the ass later that we can see as he's just walking through. They're going to call for certain things that really come out and frustrate some folks when they call for a foundation cert. Means you're going to have somebody come in there and look at the foundation and make sure this thing's stable. And he might say, well, the seller told me he did all these things. Like, you want to make sure they did it right. So we're going to need an engineer, and that costs money to go out there and verify that the foundation is solid. You want a good solid view of that. Other thing that you want to, if they see obvious pest things going on, they may call that out. I've heard of an appraiser going out there and there was no pest inspection required within the contract, but the appraiser noticed that there was an infestation of sorts and he pointed it out. Now, it didn't necessarily have a bearing on the value, but it's something he wanted to make sure people are aware of. And you as an investor want to know that. Are you going to step into a property that has problems? Take all the people that are willing to go out there, that you hire to go out there and look at it, the inspector, the appraiser, every party, and look and see what they're making mention of and determine for yourself whether or not this is something that you want. If you are not looking at those things and you're just deciding, hey, the lender will just close on the loan, there may be things that we look at that, or things we don't look at that doesn't matter to us as a lender, but should matter to you as a buyer of this property, the new owner of this property, that you should pay attention to. And I tell everybody, you are the CEO of your real estate investment business. Just because I don't see something and it doesn't affect the loan on closing for you doesn't mean you shouldn't be paying attention to it yourself. Now, if you expect everybody else to do the job for you and point everything out to you, just expect problems, because sometimes we don't look through the same lens. The importance that you have on something may not be important to me, and it might not be important to you, Melissa, and it definitely isn't important to the seller. Seller's offloading the house. He just wants to get paid.
Right. Well, that's so true. That last part that you said is, if I went through something, particularly on one of my rental properties or a house that I owned, and I faced a problem with it, it's going to stand out in my mind. So now when I'm buying the next property, I might be a little bit more sensitive to that in an inspection report. Mold is a big thing right now because, I mean, health wise, it's a health and safety standard item, but it does cause health problems to the people living there. And so I know some people who were affected by mold in their main residence. And so now when they get a rental property, they're doing a mold inspection just for the tenants that are going to be living there because it hit them so hard. And so they're extra hyper worried about it and cautious about it. And by the way, most mold can be fixed and remedied. It's not the end of the world. It's just a great idea to catch it early on if it is there. But yeah, so we definitely are all going to be looking at things a little bit different and what's really important to us based on our own life experiences. But then also, again, just to kind of reiterate that, you guys remember again what I said, the lenders are there to help you, not only to close on this property, to get you through the appraisal. Yes, the appraisal costs money. You're not just paying for a drive-by appraisal, and those are much cheaper. I know with Aaron's team, you're actually paying for the investor or the appraiser to go into the property, to put some time and some thought and some effort into it. And guess what happens? I know for a fact with Aaron's team, not all appraisers are created equal. They make mistakes. They are humans. And I tell you what, I have never seen anybody fight an appraisal more than Aaron and his team. So walk us through that, Aaron. What if somebody gets the appraisal report back and it's way undervalued what they thought? What's the first thing you guys do?
Well, let me take one point here you made and just reiterate that, guys. We're a partner of yours in the deal. Like Melissa said, we're 80% in some cases of the funds that are going in to acquire this. So look at us as a business partner that's putting up 80% of the capital for the acquisition of your business. You're putting up 20% of the capital plus costs, and then you're paying back your partner as interest that's actually diminishing with inflation. So you're paying us less and less and less, but you get to keep the asset that's growing and growing and growing, and the cash flow. You win in the partnership. We put most of the capital and we take the short end of the stick. You got to look at it the right way. And we can talk about a whole different thing. In fact, I want to put down a different conversation as to how is it the lender gets the short end of the stick in a 30-year fixed mortgage, and you're the victor and the one who wins and takes the majority of it. You're the 20% of the capital partner, but you are the majority owner. It's a pretty wild concept, and that's not how it usually works in business. But when it comes to appraisal that you're referencing there, one of the things that is the main thing you got to really look at is this property. Is this going to tell you about the property, bed, bath count, square footage, all these things? Is it matching up with what was being said to you? Now, there is certain things that get done in the BRRRR world. Everybody's heard about that, or people that are selling houses will have a drive-by appraisal. So they'll sell you something. They say, I had this some call it a pre-appraisal. I've had an appraisal done. Here's the drive-by. Here's what the value should be before you go into contract and go to get your own appraisal. So you have an idea what that looks like. Well, when a drive-by appraiser is doing that, they're 9 times out of 10 not even driving by, I believe, because you can find the exact same picture on the appraisal they give you on Zillow or Realtor.com. So I doubt they drove by and got that picture for you. They took that from the internet, and then they pulled some comps in the area, and they took a range to guess at what this is going to be like when the rehab is complete, because usually these are done pre-rehab. Well, then you start to look at what they said, this drive-by appraiser said it should be worth, and then we have a full-blown appraisal done where appraiser walks into the property, actually measures the property, walks through all the things, checks off that everything is there that they said would be there, and if there's anything different, we will know that. Now, some of the easy low-hanging fruit, when I get a low appraisal come in, we'll take a look at that, compare it, because then people send us, well, here's my drive-by, and it should be related to this. Well, I'll look at the comparable sales on the drive-by that was used versus the comparable sales that were used on the appraisal itself. Now, often I have seen the drive-by appraisal that is done, they will use comparable sales of recent rehabs that might be very superior rehabs to the one that was done when the rehab was complete. You want to be cognizant of that. So if you're buying a home that's in the process of rehab that has a drive-by appraisal done, and you're looking at this and it says, hey, this is going to be a $200,000 house. Well, look at the comparable sales used by that drive-by appraiser. Look at the quality of the rehab, the interior photos and the exterior photos. And then just know if that's what this is, and mine will look like that, then that's what I should have. Well, then you get the final product. Does the final product look like the comparable sales in the drive-by appraisal, or does it look like the comparable sales that the appraiser used when he walked through it? Which one has the best comparable sales? So then we have to argue that out. Well, I might be arguing with you and your seller saying that the appraiser picked more appropriate comparable sales than what the drive-by appraiser did. The drive-by appraiser did some fictitious ones that it might look like. The real appraiser did it what it actually truly looks like. So your valuation may not be the same. I have run into scenarios where we do have a valuation issue, where an appraiser comes in with a value and they chose the comparable sales that had the lowest purchase sales prices in the area. Well, I'm looking at those comparable sales and I'm looking at the adjustments they have. Like, well, what other areas? I'll contact the seller and say, this is what our valuation came in at. Is there some comparable sales they may have missed? So they'll look at those sales, say, yes, there's this one, this one, this one, and this one that we believe is more comparable to our property because of the way the rehab was done than the ones that they had provided. We'll look at those ourselves. We will do an internal analysis. We take a look and say, is there any foundation to this? Look at the bed bath count. Look at the amenities. Look at the quality of construction. Look at how they appear, curb appeal, all these things. And then we'll submit them and say, and just ask, is there a reason why these particular ones were not viewed or not used? We don't tell them use these comps. We want you to bring the value up. So we just ask the question. Is there something about these that made them not usable? Well, your appraisers will definitely take a look at that often and just say, hey, we did. Sometimes they'll say, yeah, I didn't even see these, because they may not have been readily available comps that pop right up when they did their quick search. They'll do as quick a search as they can. They got to move product quickly. So as a result of that, they might not come up with. They can come up, adjust their valuation or adjust their opinion based upon new data that's provided. They may even come back and say, sorry, those don't count, and stick with what they were saying, which happens on occasion. But it's not a matter of us fighting it out. It's a matter of providing better data or data that they may have not seen to help them reassess what they came up with.
Yeah, I mean, gosh, we've been doing this for so long, and at the end of the day, honestly, there really have not been that many appraisal issues that I've seen over, thousands of transactions. Obviously, they happen. It's real estate. It's people. We can't control it. It's not the worst thing in the world when a low appraisal comes in. At the end of the day, you might get a better deal on the property. The seller might have to lower the sales price and you can get it for cheaper. And I recently was dealing with somebody that the appraisal came in, I think it was like $2,000 under. And they were so upset. And they were like, that means I have to come to the table with $2,000 more. And I feel like I'm getting ripped off. And I wasn't prepared for that. What do you say to that person, Aaron? Because I literally dealt with that recently. And I have a particular, soft spot for people. And I was like, I get it. That's $2,000 more than you were planning on. What is your answer to that?
Well, there's two sides to it, how I look at that. So when I see one that's 1,000 or 2,000 off the sales price, part of me is like, okay, Mr. Appraiser, you're not so damn precise that you can come in within $2,000 on a $180,000 house. That whatever percent, it's not even 1%. You literally believe that they're 2,000 below. It was sold at 180,000. You're just like, no, this is only worth 178. Come on, right? That's one part of me. But there's really very minimal argument going there and say, come on, son bitch, $2,000. I can't really argue with an appraiser on that. So I come back to the buyer and say, hey, this is what we've got. This is what they believe the value to be. And we as a lender, we are forced is a strong word, but we are required to use the appraiser on how to base our loan. So if it's a $180,000 purchase price, we're going to base it on 80% of 178. Well, when you consider 80% of 178, it's really not quite $2,000 to have to come in with. It's a little bit off that because of the percentage, but they still have to come in with more money. So I explained to them, it's like, listen, here's your options. You can go back to the seller and say, hey, want to split the $2,000 with me, right? And that way, a little bit of offset, because I guarantee the seller's not going to lose a deal for $2,000 or 1,000. Split that. They may lose it for $2,000. They may be in the same situation, but I don't know if they're going to lose it for $1,000. Secondly, this is an expected thing. There is going to be things coming up because if you're not capable of weathering a $2,000 hiccup in your transaction, I guarantee you can't weather a turn on that property when the tenant moves out. There's going to be a lot of things you're not going to be able to do. We're not going to be able to weather the weather, right? That comes in and takes a branch off of a tree, or peels a tile off of the roof. There are things that are going to happen as a real estate investment, and you have to be prepared for that. And this is your first step into understanding things come up that you are not ready for, but you need to start getting ready. This is the easiest way to remember, start getting ready and start stockpiling as much as you possibly can in preparation. When it comes to cash flow, I'll advise heavily to every investor, do not use your cash flow to pay down your mortgage any faster than what it is. Keep that cash flow, retain that cash flow, use that to build up your reserves. Do not take the cash flow and put it in your pocket and now go use that to go vacation. That is for your real estate business, period. That's one of the things I love about DSCR, utilizing LLCs. Keep it within the confines of the companies to grow that business, not to put money in your pocket. This is not about your pocket. This is about your business. This is about your future. This is about your kids and about your grandkids.
Yep. Oh my gosh, that's so perfect. Well, I think when the client was upset about this $2,000 difference, I think it was more, for some reason, they thought that they were getting screwed over. Like somebody sold them a property for $2,000 more. And I think it wasn't a thing. They had the money to pay for it. It was just like this, like stubborn mentality is like, no, I wrote the contract for this price and this is the price I want to get it at. And so to me, it opens up a much, much, much bigger thing when we look at all the amazing benefits of real estate. They're going to make that money back through cash flow, through appreciation, through inflation, through rental increases. Like they're going to make that money back. So it's a much bigger thing, which makes me go back and go, okay, let's go back to the basics. Let's look at all the profits of real estate. Let's run those numbers and then tell me if you think that, if the seller split it with them, that $1,000, let's just kind of put our ego aside, our stubbornness aside, and let's really look at the true profits of real estate.
We do lose a lot in our careers. We lose a lot in our relationship. We lose a lot in business. We lose a lot in opportunity to stubbornness. Where people want to hold that line. And if that's the line you want to hold, I guarantee somebody else will come in and take advantage of that particular line and they will win. There's a lot of people out there taking deals from other people just because they're willing to see the long-term benefits rather than being standing right here saying that this is the ground I'm going to stand on. I'm going to take this hill, right? Well, in taking that hill, you took a great opportunity away from yourself.
Yep. Yep, I agree with that. Well, thank you, Aaron. Today we're going to wrap it up because this one is just going to be a quick episode. But once again, you came with your knowledge bombs, and I'm so grateful to have you as a resource. And also, you helped me out on an appraisal last week, which is why it was fresh in my mind. I'm an investor to you guys. I close on properties. I use the exact same people and the exact same resources that I'm telling you guys about. Aaron and his team absolutely killed it for me. There was a problem with the appraisal. They went to town. They worked with me. They worked with the seller. They worked with the appraiser. We got it taken care of, and I ended up very, very happy. So thank you again to you and your team, Aaron.
Well, and in that situation, just so you guys know, I've been doing this for 27 years. I have seen thousands upon thousands of appraisals. I have learned a lot about analysis, and look at this. And there's a specific member of my team, Karen, that's all she does all day is looks at appraisals. Our job is to make sure that we get it to as close as reality as possible and know that there's humans involved. We can't influence, we can just give data. And if the data works in your favor, it's great. If it doesn't, we just do the best we can with it and see how to readjust to the conditions of that transaction. But I appreciate you, Melissa, with the trust and another opportunity to be on here. Guys, if you need anything from me, info@aaronchapman.com is the best way to get a hold of me, or just go to aaronchapman.com. We'll connect up.
Wonderful. Thank you again, Aaron. Talk to you again soon.
Thank you.